Let me start this video with a picture on your screen. You can see the men in blue celebrating India's victory on winning the Cricket World Cup in 2011. It was an evening full of josh. The stadium was packed. Fans cheered as India lifted the trophy. The energy was electric. Now shift that excitement from the sporting field to the investing arena. Nifty 50 has reached an all-time high of 20,000. If you look at Nifty's one-year gains, those are around 14%. However, your SIPs in diversified equity funds would have got you returns of over 30% in 1 year. Most of these gains came in the past 6 months. Returns of many diversified funds are over 20% in this short period. So just like that stadium filled with euphoric fans after India's victory in 2011, many investors would be celebrating their decision to invest in equities. But as we know, all-time high can be double-edged sword. The thrill of the moment can easily make some investors greedy for more. A simple data point highlights the FOMO investors feel when the markets start to rally. In April this year, we saw SIP inflows fall to 5-month low. That month saw inflows of around 13,700 crores. But as markets rallied, the flows have started increasing since then. August recorded the highest ever SIP inflows of 15,800 crores. But all-time highs can also make investors worry and have doubts. And this is bound to happen. We have seen that sometimes market rallies are not backed by fundamentals. They are driven simply by sentiments. And this can make markets expensive or overvalued. And after such frothy rallies, we have seen sharp corrections. That brings us to the question that we are going to address in this video. Are markets overvalued right now? Right at the start, let me point out that there is no one answer to this question. It depends on the parameter you look at. Therefore, we will not look at just one parameter. We will look at 4 different valuation metrics. This should give us a fair idea about the current state of the market. But before we begin, a quick reminder. You're watching this video on ET Money's English channel. We also have a Hindi channel where you can watch all our videos in Hindi. And if you're someone or know somebody who wants to understand money and finance in an easy way, we have a channel called 5-Minute Finance. Do check it out. Now let's begin. Before we start looking at the valuation metrics, let's briefly talk about the state of the markets right now. The last 3 years have been a roller coaster ride for the Indian economy and the markets. The markets faced the COVID-19 crash, ripple effects of Russia-Ukraine war, the Adani saga, soaring inflation, interest rate hikes and whatnot. But despite all those events, the Nifty 50 index has touched the 20,000 mark. Now, optimists point at a number of reasons for this. India is the fastest growing economy in the world. Inflation could be coming under control and therefore RBI has paused the rate hikes. The rising GST collections show that businesses are doing better. All this points towards a better future. And then there are those who may point out at one single factor to counter the optimists. Earnings are not growing as much as the stock prices. On the face of it, both sides seem to be right, but only time will tell who wins. For now, let's look at what numbers tell us. Let's start with the first metric, price to earning ratio. Now the P ratio is a very popular valuation metric. It helps you understand the price at which you are purchasing or selling an asset. Is it too much or too little? Now there are many uses of the P ratio and we've covered these in another video on our channel. I'll be sure to add a link of that in the description. Now P ratios are studied in 2 formats, the trailing P ratio and the forward P ratio. Let's start with the trailing P ratio. As it stands, the Nifty 50 12-month trailing P ratio is at 22.67. But how did we get to this number? We simply use the Nifty 50 price, that is 20,070, along with the earnings per share of the Nifty companies, which is at 885. So 20,070 divided by 885 gives us 22.67. Now if you compare this with the P ratio of the last 20 years, then they're quite similar. The 20-year average Nifty P ratio is just around 21.55. That's pretty close. In fact, if we direct our attention to 5-year and 10-year average, the valuation may appear reasonable. Now if you look at the chart on your screen, you can see that there is a peak. The peak of the chart is when this ratio reached a level of 42 between February and March 2021. But at majority of times, it has remained between 20 to 25. From these data points, the market doesn't look in a euphoric mood. But remember, I also said this metric needs to be studied on the forward PE ratio basis as well. Now, a forward PE ratio simply implies that you divide today's earnings with the expected earnings over the next 12 months. Now, this future forecasting of earnings gives us an idea of how much of earnings growth has been factored into the calculations. Now, let's understand this by mapping the Nifty EPS over the last few quarters. Now, the really good thing about earnings is that it generally follows a rather linear pattern, and barring some colossal events such as a pandemic, it tends to be quite predictable. So in the last 5 years, the average growth in earnings has been around 16.5%. And if we expect earnings to rise by 15% in the coming 12 months, then the EPS of 885 would increase to 1018. And if we use forward earnings to calculate the forward PE, then it will come out to be 19.7, which is lower than the 20-year average of 21.55. Similarly, if we assume the growth rate of 10% or 6.5%, which is expected GDP growth rate of FY24, then we arrive at different Ps. Now, different people are likely to have a different view of these things. And since everything is in the future, it's difficult to say what's right and what's wrong. But our point is that a combination of the trailing and forward P ratios can be a good indicator of whether and by how much are the equity markets over or undervalued. And for the current scenario, the market neither looks overvalued nor looks undervalued. Now, in the previous section, we looked at the earnings posted by index companies. However, the earnings in the recent past were affected due to the ramifications of unpredictable events such as the coronavirus pandemic, high inflation, recessionary fears, etc. Now, while these events were big, there are many smaller infractions that happen all the time, like interest rate changes, seasonal demand, business cycles, disruption in supplies, etc. And it is for this reason that many investors prefer to use the cyclically adjusted price-earning ratio. This ratio is also called the Schiller price-earning ratio in recognition of Nobel Prize winner economist Robert Shiller, who created this metric. Simply speaking, the Shiller P ratio is a P ratio that is adjusted for business cycles and inflation. It is calculated by using the average of inflation-adjusted earnings over the last 10 years. This helps smooth out the impact of economic cycles and short-term fluctuations in corporate profits. Now, with regard to India, the only published data we could find was on a website by Siblis Research, which says that the Nifty 50 Shiller P ratio on 30th June 2023 was 32.95. The table on your screen shows the Shiller P ratio, which is also called the CAPE ratio. The research house publishes this semi-annually. Now, if we plot the data on a graph, then the chart is positively sloped and the 7-year average CAPE ratio is 28.05. However, the data we have is as of June 30th, and since then, the Nifty has gone up by almost 5%. If we do a simple extrapolation, the current Shiller P ratio would be close to 35.6. which is definitely above the historical average zone. Now, the Shiller P ratio is definitely an improved metric over the simpler P ratio, as it gives a good long-term direction to your over and undervaluation analysis. However, it should be looked at the conjunction with the earnings graph, because it may also lag behind significant changes in corporate earnings. So during periods of rapid earnings growth or decline, this ratio might not reflect the most up-to-date earnings information. The market cap to GDP ratio is also called the Warren Buffett indicator and is often cited by him as one of his primary directional tools to understand if the stock market of a country is cheap or expensive. It's a very high level metric and is calculated by taking the value of all publicly traded stocks in a country and dividing it by the nominal GDP of the country. For example, the total market cap of listed companies in India is about $3.24 trillion. And the nominal GDP of India is about $3.28 trillion. So $3.24 trillion divided by $3.28 trillion gives India's market cap to GDP ratio of approximately 99%. What is the reasonable ratio for us to consider? If we do a time period analysis of this metric, then the 10-year average is 90%. The 10-year max was 120% and the recent 10-year low was 58%. Similarly, we can create the M cap to GDP ratio for a number of major economies and do a comparative analysis. Now, what we say here is that the United States is the most hated at 168%, while the German and Chinese MCAP to GDP indicators are in their 50s. So based on this, it looks like India is trading at premium to its own historical average and some of its peers. Like all indicators, there are many who feel that this ratio is not the right one for India, where all parts of our economy are still unorganized and not represented by listed companies. However, Warren Buffett likes it, and so we should give the MCAP to GDP ratio some consideration and definitely add it to our arsenal of overvaluation and undervaluation indicators. BEAR is an acronym for Bond Equity Earnings Yield Ratio. This ratio is a simple comparison between the bond yields with the stock market earnings yield. So in the numerator, we have the India 10-year government bond yield, which is currently at 7.13%. And in the denominator, we use the stock market earnings yield, which is nothing but the reverse of the P ratio that we discussed in the earlier section. Now, since the current P multiple is 22.67, the earnings yield comes to 1 divided by 22.67 or 4.41%. So 7.13 divided by 4.41, we have the BEAR ratio of 1.61. Now, this number cannot be looked at in isolation, and it is important to map it over the long term. If you look at the long term data, then as of last year, the average BEAR ratio for India was approximately 1.56 over the last 2 decades. The BEAR indicator says that when this number goes above the red line, it signifies an overvaluation of the stock market. And when it is below the red line, then the stock markets are undervalued. We can see here that the current BEAR of 1.61 indicates the stock market in India are in line with the long-term valuations. Now, some analysts prefer to use the forward PE instead of the trailing PE. And when we do that, then the BEAR based on the forward PE comes to 1.46. The BEAR with the trailing or forward ratio is another good indicator to determine the state of valuation of the stock markets. It's not easy to take an investing decision when being bombarded with too many and often conflicting statements related to the stock market and the economy. When markets are high, you can expect a flood of goody-goody news clips, and when the markets are on the low, one tends to hear mostly end of the earth stuff. In such cases, the best thing you can do is to keep your ears trained on understanding the impact on the real economy and more important things like sales, revenue, operating income, margins, leverage, cash flow and profits. That's our first suggestion. A second suggestion is on using the indicators that we presented in this video. The P ratio, the Shiller's P, MCAP to GDP and the bond equity earnings yield ratio are all good indicators of overvaluation and undervaluation. And while each has its own pros and cons, it is important to remember that valuation can never become a game of certainty. It's more of a quest that makes the possible plausible and the plausible probable for your investments. Now, if we relook at the 4 metrics, then 2 of the metrics show that the markets are overvalued and the others show that they are in line with the long-term valuations. It's a 50-50. So the only thing you can conclude is the markets are not cheap. Whether they are overvalued or in line with the long-term valuation, it will pay to be cautious. The rallies from here would definitely put the broader markets in the overvalued zone. So based on our analysis, here are 4 things you can do. 1. Avoid lump sum investments. None of the indicators show markets being undervalued. So it's better to avoid lump sum investments. That's one way to be cautious. 2. Rebalance your portfolio. If the rally has tilted your portfolio towards equity, you can book some profits and rebalance your portfolio. It helps you take benefits of the recent rally. 3rd, don't stop your SIPs. As SIPs, it doesn't matter if you are investing at market highs or lows. And 4th, understand that mid and small cap investments come with volatility. The exercise we did was for the Nifty 50 index, but some brokers have pointed out that the mid caps and small caps are highly overvalued. One such example is Kotak Institutional Equities. The broker said that the primary driver of the rally in the mid and small caps appear to be irrational exuberance among investors. Mid and small cap investments are usually volatile, meaning they rise higher than Nifty 50 and fall steeper than the broader index. Typically, mid and small cap should not be more than 30 to 40% of the portfolio. So it's time you can also do rebalancing your equity portfolio in case mid and small cap allocation has changed due to the rally. If you're not sure how to do all of these things, then you can go to the ET Money YouTube channel and search for videos on these topics. You will find most of them there. I hope you like this video and will draw many learnings from the data and the insights presented. And if you found this video useful, don't forget to share it with your friends and family. And don't forget to subscribe and like this video. I will see you with a new video very soon. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.